the price of a stock will follow the direction of earnings in almost every case. You can generally state if a company's earnings go up sharply, the stock's going to go up. If earnings go from very poor to mediocre, the stock's probably going to rise. If they go from mediocre to good, it's probably going to have another rise. If it goes from good to excellent, it's probably going to have another rise. Or if a company's earnings grow dramatically over a long period of time, then the stock's probably going to go up dramatically. Even if you have a Waterford crystal ball, you probably can't predict the company's earnings. But Wall Street is a whole army of people who make such predictions by computer. You can get Wall Street earnings estimates in the research section of the stock shop or through many other online services. Or you can go to your local library and find earnings estimates in Value Line or Standard & Poor's. Obviously, you want to invest in companies whose earnings are expected to rise. But again, these are just estimates. If you really understand the company, you should know how it plans to make earnings rise. If you know it has good growth prospects, then you'll be better able to evaluate the company as an investment. You can't predict the future, but you can learn from the past. A company with a long history of earnings increases and the dividend increases is obviously a stable performer that has a reasonable chance of continuing to perform well in the industry. Many times, that's a good company to investigate further. Johnson & Johnson has raised its earnings something like 19 in the last 20 years. It's raised its dividend over 30 years in a row. But just because a company has had a great record in the past does not mean earnings will grow terrifically well in the future. You have to have reasons for it. Strong growth in research and development, cost cutting, new products, a great brand name, and a terrific balance sheet were the items that made me optimistic about Johnson & Johnson. And what's the outlook? If that's going to keep continuing to grow, they run out of steam. The stock's going to run out of steam. Price earnings ratio is something that some people make very complex. It's actually very simple. If a company is selling at $100 a share and earning $10, it has a price earnings multiple of 10. The PE ratio can be thought of as the number of years it will take the company to earn back the amount of your initial investment, assuming, of course, that the company's earnings stay constant. Why look at PE? It can tell you if you're paying too much for a stock. The higher the PE, the more expensive the stock relative to the company's future earning power. The lower the PE, the cheaper the stock. I use a rule of thumb to level out these differences. A fairly priced stock has a PE that's about equal to the expected annual growth rate over the next 3 to 5 years. If the PE is substantially higher than the growth rate, the stock is normally expensive. If the PE is substantially lower, the stock is probably cheap. A stock's PE in part depends on the industry it's in. When you look at a growth company, compare the company's growth rate and its own PE to that of the industry. All other things being equal, if you find a company with a much lower PE and a higher growth rate, you're off to a good start. You can also compare a company's to its own historical PE. If a company normally sells for 25 times earnings and now it's selling at 15 or less. You have to ask yourself why. The company could be maturing, competition may be entering the field, and its growth prospects may be uncertain, but maybe it's simply been beaten down by some other factors and it's possibly a bargain. It's worth researching. Back in the 1970s, electronic data systems, or EDS, had a PE of 500 times earnings. If you had invested in a company with a PE this high, when Columbus discovered America and the company's earnings had stayed constant, you'd just be breaking even today. In 1974, EDS performed very well, but the stock fell from 40 to 3 simply because the stock was so grossly overpriced relative to current earnings. Alright, so let's dive into the price earnings ratio, often abbreviated as PE ratio. The PE ratio is a key metric used to evaluate the value of a company. Essentially, it compares a company's current share price to its per share earnings. You know, it's one of those fundamental tools investors use to determine if a stock is overvalued or undervalued. Now, when we compare PE ratios, we're looking at how one company's valuation stacks up against others in the same industry. This comparison can give us insights into market expectations and potential growth. It's like if one company has a significantly higher PE ratio than its peers. It might be because investors expect higher growth from it. On the flip side, a lower PE ratio could indicate that the market has a lower expectations, or perhaps the stock is undervalued. Moving on to historical PE ratios, this is where we examine a company's PE ratio over time to identify trends and patterns. By looking at historical data, we can see how the company's valuation has changed in response to different market conditions. It's, a way to gauge the company's performance and investor sentiment over the years. This historical perspective can be incredibly valuable for making informed investment decisions. Finally, let's talk about electronic data systems, or EDS. EDS was a significant player in the information technology services industry. Understanding its PE ratio over time can provide us with a clear picture of how the company was valued by the market. It also helps to see how the company's earnings and stock price evolved, reflecting its business performance and market conditions. So, by analyzing EDS's PE ratio, we can learn a lot about its financial health and investor expectations during its operational years.